Let's focus on CSB Bank now. The problem is their asset quality saw a big deterioration in Q4. Slippages are also elevated. Their corporate book has also shrunk, although deposit momentum is strong. Pralay Mondal, who is the Managing Director and Chief Executive Officer at CSB Bank, joins in now. Mr. Mondal, always great speaking to you. Good to see you in this morning. Of course, the first question that shareholders would want to know is the deterioration in asset quality. Can you tell us what led to this surge in slippages? Was it any one-off this quarter? And what is the average slippages that the bank would have over the next few quarters?
Good morning, Sonia, and your viewers. Absolutely relevant question that our gross NPA and net NPA did slip a little bit this quarter. But as you rightly said, it is a one-off. There was one account which has a coverage of around 70 crores with us right now, outstanding. And for some technical reasons, it slipped this quarter, though it was not in our watch list at all. So that's why we didn't discuss it last quarter. Otherwise, we would have given disclosure. And we are pretty confident that we will reverse this definitely in this FY and hopefully in the next 2 quarters. So this is something which is not worrying us too much overall. And if you take this out, now how does it impact the overall NPA? There is 18 crore in terms of provisioning because we do 25 crores provisioning. And there's another 2 crores of around interest impact, which overall takes it to 20 crores. If you take that 20 crores out, I think overall GNPA, NNPA, PCR, the coverage ratio, all of that looks typically the way we have been covering for the full year. On your second part of your question, that how do we see next year? Next year, we would be in line with what we had been till Q3 this year, which is gross NPA will be similar to where we were, and net NPA and coverage and slippages will be similar to what we were till Q3 FY24. So this was an exception, and this we will recover from this very quickly.
So you're saying the slippages on an average will be what you did in Q3, which was around 40 crores odd. That would be the average that you're looking at over the next couple of quarters? Or will it be much higher than that?
On a percentage basis, yes, on a percentage basis. And overall GNPA will be somewhere between 1.3 to 1.4. And NNPA will be somewhere between 0.3 to 0.35. And we will be back above 70% in terms of our PCR, which is the coverage ratio. So we're pretty confident of that. And while we're talking about credit cost, our credit cost for the full year basis was still negative, 2 basis points negative. So it has not really impacted the overall yearly numbers. And we hope that next year also our credit cost should be below 10 basis points.
Oh, wow. Credit cost for FY25. Pralay, hi, morning. Prashant here. Credit cost for 25 to be under 10 basis points. You don't think this will, that is exceptionally low? You don't think that will will normalize, much normalize? We had Amitabh Chaudhary with us, I think one of the interactions I think it was last quarter. Of course, in a different context, he was saying for the banking sector, credit costs will normalize. It has to normalize. These are very, very low levels we're at. So just sort of contextualize that in the context of CSB and then also talk to us about NIMs, net interest margins. What's your sense for that for FY25?
Thanks, Prashant. No, you are right. The bigger banks will have more normalized kind of numbers. For us, we must appreciate that for more than 45% of our portfolio is gold loans, where the slippages and NPA is very low. Credit costs are almost close to zero. So to that extent, it helps us. Also, if you look at the last 2 years, we have been closer to zero in terms of our overall credit costs. So I'm being pretty conservative when I'm talking about 10 basis points in terms of credit cost next year. Hopefully, will be lesser than that. Coming to NIMs, yes, you're right. I think the entire banking system is going through a little bit of a transition on the NIM because deposit costs have gone up for everybody. That is true for us as well. Our NIM has come closer to 5% now. And next year, I think will be somewhere between 4.5 to 5, closer to 5. And that's primarily because of 2 reasons. One is some tail of the deposit cost will continue to impact the entire ecosystem, including us, for another quarter or so. but that will be not much. The other reason is we also are gradually planning to shift our asset book gradually more towards wholesale, SME, retail, because today the gold is almost 48%. So to that extent, I think the NIM will get little impacted, but it will be compensated by our overall fee income and fee businesses. And hence, from an overall ROA perspective, which we closed this year around 1.79, I think we should be able to hold close to that.
All right. Hi, Mr. Mondal. So 4.5 to 5%, but closer to 5% is the NIM guidance. We got that. You know, there's another player in the gold business, which is IFL, and they have been wrapped on the knuckles. Have you seen any kind of shift towards banks? Has that been more inquiries for your gold loan business?
Good morning, Nigel. I think we are in a different segment of business because typically the interest which we charge our customers are in the range of 12, 12 and a half or even lesser. And NBFC's interest rates are almost 50% higher than us. So to that extent, the segments which you're talking of are very different. So it will not necessarily give us more business. The second question which Prashant had asked, I think I just sort of wanted to allude to is overall, I think the wholesale side of the business will grow for us next year, and SME also will grow next year. So to that extent, the gold portfolio impact will be a little lesser, and hence overall our balance sheet will look a little more balanced from that perspective. But coming to next year growth, I think gold growth will continue to grow for us, but not at the cost of others. We have our own ways of building our portfolio, and we'll do that.
Okay, all right. Mr. Mondal, besides the numbers, you know, we spoke to you a couple of weeks ago as well. I just wanted to ask you, is there some inorganic growth plans? Because there is some kind of buzz that maybe CSB is on the prowl, and maybe one of those PSU banks could be on your radar. It's happened in the past, I recall, with Bank of Maharashtra, I think so. And what about, are you all on the prowl again? Are you all looking at any PSU bank?
See, purely from a CSB perspective, I can tell you that we are building the bank completely organically. I can't answer on behalf of Fairfax, who's an investing company, and they can look at whatever opportunities they want to look at. But from our perspective, we are clearly looking at organically growing the book. And if you look at our biggest investment this year is into technology, and most of our technology investments are not in line with the bank you're talking about. Our core systems are different. So to that extent, had I known that there is something happening, then we would have done it differently. So very clearly, we are organically growing our bank right now.
All right. Thank you very much, Pralay, for joining us. It's a pleasure, and it's always nice to speak with you. Good luck, and speak again. Thanks very much for joining us. That's CSB Bank, and running us through some guidance for FY25. Absolutely fantastic. The stock's done phenomenally well. Last, I think, 1.5 years, it's basically doubled from under 200 to nearly 400 now. And, they seem to be on a pretty solid, steady track, very strong net interest margins, and continue to hope to be around that 5% level, 4.5 to 5% numbers, even as they continue to balance the book, so as to speak.